AICPA Town Hall, a high-impact news broadcast to help you navigate the most pressing issues facing the profession. Get timely and critical information, real-time interpretation, and analysis. Learn strategies, best practices, and capabilities to drive long-term success for your clients and organization. Thursdays at 3 p.m. Eastern Time.
Well, good afternoon, everybody, and welcome to this Thursday, June 23rd edition of the AICPA Town Hall. My name is Michael Cerami, and I'm sitting in today for Eric Auskerson. Eric would love to be here, as you know, but he's actually at his daughter's 5th grade graduation ceremony as we speak. So I'm very hopeful, Eric, that you're not streaming us in on your iPhone right now. Hopefully you enjoy the afternoon with the family. Well, welcome, everyone. And as usual, we have a full agenda for all of you. Really excited about today's content, as well as the subject matter experts that will be joining me here in just a moment. So today we intend on covering our DC and profession update. Lots happening. We're going to have Lauren Pfingstad from the AICPA advocacy team come up in just a second and take us through key events and happenings. We're going to have a technical issues update from Carrie Hipsack, and Carrie will be joined by Lisa Simpson. Lisa's also going to take us through a sales and use tax landscape, highly complex area right now, constantly changing. She's going to help demystify it a bit for us today, and kind of alert you to things that you should know, whether you're in industry or working closely with clients. And Lisa will also be joined by a few subject matter experts on the topic. And then lastly, we'll close with open forum and closing remarks, and hopefully can end on an interactive note. So with that, let's go ahead and jump in. Here's our list of speakers today. Again, a great group of subject matter experts, and we're going to bring them in just a minute. So with that, I'd like to go ahead and bring in Lauren. Lauren, welcome. You've kind of done a very interesting thing for us here today. For those of you that don't know, when Lauren's not speaking on the event, she's working feverishly behind the scenes, answering questions and collecting information that you all are submitting. And Lauren's done a great job here of organizing some of the more commonly raised town hall tax policy questions, is going to kind of walk us through responses for each. So Lauren, welcome, and it's great to have you here with us today.
Thanks, Michael. I'm glad to be here. And, I'll just say, being on the back end and getting to see the questions coming in makes me a smarter, staffer for the AICPA, because you have your finger on the pulse of what the profession cares about. You see the same questions, and they're good questions coming in over and over again. So you kind of see these buckets of what people really care about. So thank you, really, to people, the audience members, for submitting these questions and being thoughtful about it, because it benefits me and it benefits the association and the profession. So when I look at the questions that are coming in every other week or so, I focus mainly on the questions about federal tax policy. And as Michael said, there's kind of a bucket of questions that keep coming in. I'm going to call them commonly asked or frequently asked questions. And I can't always answer the questions in the Q&A as fulsomely as I would like to. So I'm going to try and spare some typing and address a few of those FAQs up front in this presentation. So the first question I see a lot of is Congress going to reinstate the 2021 fourth quarter employer retention credit? And this is a really good question for a few reasons, right? There is bipartisan legislation pending in both chambers of Congress that has over, I think it's 100 co-sponsors, which is a strong sign of a bill that has a lot of support. There's also an impressive coalition of industries and nonprofits that support this bill and are promoting it. And they've been advocating for months to restore that fourth quarter access to the ERC. And as a result of those kind of coalitions and those forces of support, we're constantly seeing news stories about the potential for this bill to pass. But the answer and the reality is it's really unlikely that Congress reinstates this credit. It's too costly. It's about $7 billion. There's no immediately available offset. The administrative complexity of going back and doing this is pretty high. And the fact that employers are trying to find and hire staff, right, rather than retain staff right now, means that on a policy level, this is not going to appeal to enough members of Congress to clear the bar for passage in both chambers. Now, the other ERC question, and we're seeing more and more of this appropriately every other week, is whether Congress is paying attention to the aggressive and perhaps fraudulent marketing of ERC by non-CPA firms and individuals. We just briefed a very senior member's staff of the Senate Finance Committee on this issue. We're not naming names, we're not calling out bad actors, but we are educating and providing examples of the alarming positions that some of these non-CPA firms and people are taking. And we're explaining why it's really concerning for practitioners and their clients. The answer to this, is Congress paying attention? Yes. I think key members of Congress are picking up on this, and I wouldn't be surprised if members started to raise more awareness of this issue as part of broader concerns about fraud in COVID-19 relief programs. The House actually just passed a couple of bills that would establish longer statutes of limitations for prosecutions relating to fraud in PPP and EIDL. So interest in chasing down COVID, relief program fraud is high now. It's going to be just as high next year. The third question I see a lot of, and this is also a great question, is whether auto dealers and other industries are going to see some kind of LIFO tax relief this year. I think, as most people know, the AICPA has been advocating since 2021 for Treasury to provide tax relief to those businesses that use the LIFO inventory accounting method who have struggled to maintain inventory because of the global supply chain disruptions during the pandemic. Now we know and we think that Treasury has the authority to offer this relief on their own to auto dealers and other industries under Section 473, but Treasury is saying that they don't have that authority. Congress is stepping in. There is pending legislation in both chambers, which we support, that would provide relief to auto dealers only. Now, that is a narrow bill, right? We obviously support broader relief for more industries, but this is the bill that has the best chance of passing. And if relief for auto dealers can pass this year, it's possible that other industries can put forward more concrete evidence on how they're harmed, and they might be able to get something passed next year. So the answer to this is, are the auto dealers going to see relief? It's really still up in the air. We're trying, and other supporters are trying, to attach the language to the USICA Competes conference report. That's the Chinese competitiveness legislation that I think stands a really good chance of passing and being signed into law in the next couple of months. If that report contains a trade or a tax title, then the LIFO relief language has a very good chance of being included. If the trade and tax portions of those bills are eliminated, which could absolutely happen, then the LIFO bill supporters, and including ourselves, are going to work to attach the language probably to a year-end extenders package, really any vehicle that exists the rest of the year. I'll say one really interesting bit of intel that emerged about 2 weeks ago on this was that the Treasury Department and the Joint Committee on Taxation have been working together to refine the existing legislative language on the bill so it could be quickly implemented upon passage. Treasury does not do this for every pending bill, right? This is Treasury telling us that they think this bill has a really good chance of being enacted into law, which I think is really good news. The fourth question I see a lot of every 2 weeks is whether we're going to see a retirement plan savings package this year, and when. So the answer here is yes. I think there's a very good chance that we're going to see a package come together probably in July or September. There is already a package advancing in the Senate. That's the follow-up legislation to the 2019 Secure Act. That bill in 2019 passed with huge, overwhelming support from both sides of the aisle. And, Congress is like Hollywood in that if something kind of works, you're going to get a sequel. So, the Senate is advancing a package. The House passed its retirement package back in March of 2022. So all that really needs to happen now is for an informal conference to happen and the House package and the Senate package to get coupled together. Things can always get lost in translation. There are a lot of technical details between the two packages. But I think there's a really good chance a bill will pass by the end of the year. Another common question is, when are we going to see a tax extenders bill? I have this question too. This is the vehicle that's always the last tax train to leave the station, so to speak. So every pet tax issue that doesn't ride on a previous vehicle is going to try and hop on the tax extenders bill, which means everyone's going to be internally and externally lobbying on it. That can slow it down a bit, but typically what you see is that a tax extenders bill comes together closer to the lame duck session of Congress, which is near the end of this year. And the last really common question, and I haven't seen this much in the last 2 or 3 months, which makes total sense, but it's going to pick back up, is are we going to see a reconciliation bill? And what are the major tax law changes that will be included? And for this, we're going to go to the next slide, because as we all know, this comes down to Senator Joe Manchin. What he wants, he gets. I'll say Democrats are cautiously bullish on the possibility of the bill, in part because it's pretty clear that, again, it rests in Joe Manchin's hands, and also because the top line number has dropped, right? This is not going to be your $2 trillion, $4 trillion, Build Back Better bill that Democrats were talking about a year ago. This is going to be much smaller in size and in scope. And in terms of the scope, there is general agreement about what the major pillars of the bill should look like. You're going to see corporate tax raisers, an extension of subsidies for insurance plans on the Affordable Care Act's marketplace. That piece is really important to Democrats. It's being negotiated right now. There's going to be some provisions to narrow a coverage gap in Medicaid, definitely some deficit reduction, something to lower the cost of prescription drug prices. That's got a lot of bipartisan support, even though the bill itself will not be bipartisan in the end. And then some energy provisions. The window for a deal is closing fast. We do not have a lot of remaining in session days left, but talks are going on between Majority Leader Schumer and Senator Manchin. So I don't want anyone to be surprised if an outline emerges in the next couple of weeks. And I think that's the goal. It's maybe not legislative text, but an outline and agreement that Democrats can get around in principle. And that would, I think, make the party feel better about their chances of passing a reconciliation bill in September. So, nothing final has been drafted. I'm not saying they're any closer today than they were 2 weeks ago, but they've got to get something done soon. And I want to reiterate again, if something comes together, and that's still an if, it's going to resurrect relatively few provisions from the original Build Back Better draft. The most prominent corporate tax raiser I think you all know about is going to be the implementation of a minimum book income tax on corporations. We have repeatedly and publicly lobbied against that. But right now, the Democrats seem to be in lockstep as that's one of the corporate tax raisers they could get behind as a group. So, I've talked about the fact that we don't have a lot of in-session days remaining. And so on the next slide, I'm bringing up a slide from a town hall we did about a month ago, where we talked about, here are all the items that Congress feels like it has to accomplish before the end of the calendar year. And here are the items that are on their radar screen, things they'd like to accomplish. Other people might see them as must do, but the reality is these are kind of would like to have or on the radar screen issues. And I edited that old slide to show you that Democrats are adding things to their agenda. But they're not adding, additional on-session days yet. So the reality is a lot of the things have to just fall by the wayside. And what are those things going to be? July is going to be an extremely busy month as the majority tries to make headway on a lot of these issues. If you look at the first item on the radar list, we think gun safety legislation will pass Congress this month. But you can imagine that circumstances and political pressures are only going to add more items to this agenda. Student loan forgiveness, we threw that on there as a good example. House progressives are really demanding that the president do something if Congress can't do something legislatively. And as we approach the midterms, you're going to see this more and more of this tension between all the things that Democrats would like to do and the things that realistically they can get done.
Lauren, I was just going to point out too, what's in red on the right is just stuff that's been added since we last since you've last communicated with the town hall. So you were just calling those out, right?
Exactly. That's exactly right. And I could come back in 2 weeks, or Mark Peterson could come back in 2 weeks, and we could have 12 more items in red, new things being added. And that's just the reality of what a party faces when, they're up in the midterms.
Yeah, let's hope not, but you're right.
Got enough to get through as it is. And I know I'm not doing a deep dive on any of these issues. We've talked a little bit about a retirement bill. I want to make a plug for the Washington Tax Brief. This is put on by the exceptional AICPA tax advocacy team. And you can register. It's happening next Wednesday. I know they are going to do a deeper dive on the House and the Senate versions of Secure Act 2.0. That's the retirement plan package I mentioned. If you're interested in that, I highly recommend watching the tax brief. It's always really well done. And Michael, if you don't have a question, I think
I actually do, Lauren. I did want to ask one question before we maybe segue. So on Tuesday, it was announced, or the IRS, I should say, announced that it was close to processing all of the original individual tax returns received in 2021. Then on Wednesday, the IRS's watchdog said that the backlog of unprocessed tax returns is actually growing. So for those of us that maybe don't speak IRS, maybe you can help reconcile those two things, which seem pretty contradictory.
Yeah, I read those some of those competing stories, and honestly, Michael, it kind of reminded me of when I was a kid and my parents would tell me to go clean my room. So I'd run up there and I'd make my bed, and then I'd shove the dirty dish and the socks and the clothes underneath my bed. I'd be like, "Look at my clean room." And then my parents would lift the bed skirt and be like, "Look, this is not a clean room. Look at what you're hiding." And, I don't mean to be flippant. I know this is a very serious situation and the IRS is putting a lot of effort into it, but that's kind of what it feels like. The contradictory stories are it's all about how the IRS words things, I guess is how I'd put it. Like, they're getting through those originally filed individual returns, which I think accounted for something like 8 million of the 24 million piece mail item backlog. But they're not mentioning their amended returns or the correspondence, which we know is picking up again because CP14 notices are going out. They're not talking about the fact that you've got 2 more deadlines coming up where you typically get more complicated returns coming in. So, we appreciate their effort. We know they're working hard, but there's obviously still work to be done.
Yeah, there's lots of layers to this stuff. So that makes sense. And again, to Lauren's point, encourage you all, if you're available, this Washington Tax Brief really is a great way. We have a lot more time to go deeper on many of the things that Lauren just ran through. Lauren, that was a fantastic update. Lots of activity on the docket. We appreciate you bird dogging it all for us. And we'll have Lauren back with us shortly for the open forum. So we'll try to work in any questions you may have on what she covered. So thank you, Lauren. So kind of keeping with or closing out advocacy real quick, I want to bring in Lisa Simpson because we did have some change relative to or related to the Russian sanctions, specifically the professional services aspects of the FAQs. And so, Lisa, you're going to go ahead and take us through this. There's a lot of words on that slide, but you're going to help summarize it for us.
Thanks, Michael. And this is good news. So it's good news for the profession, because if you remember back in March when Russia invaded Ukraine, there were immediate sanctions placed on all types of activities going on in Russia. Then in May, there were more sanctions. Then there were executive orders. And then another executive order came out in June. And we were just concerned about the ambiguity in the sanctions, that some of our CPA firms might inadvertently get caught up if they had any interactions with a Russian-owned or Russian subsidiary that has U.S. operations, or if you had an individual client that might have an ownership interest in something that was based in Russia or had tangential Russian ownership. So it was really murky and really undefined. So we've had our DC team reaching out to Treasury to try to get some insights into narrowing the scope of just the uncertainty around what was available as continuing the service for a client and what was not. So basically on June 9th, we got a set of FAQs from OFAC, which is the Office of Foreign Assets Control, things I never thought I'd talk about in my career, outlining some FAQs that give us clarity around some of the services that are permitted. So if you read that sanctions or that FAQ, you'll see what's not permitted, but I've also pulled out a couple of examples that are permitted. And I think long story short, there is a recognition that Treasury would like CPAs to be involved in the work that needs to be done. So you might have an 1120S return that needs to be filed. You might have a payroll tax return, or you might be auditing a pension plan, but there's some type of tangential Russian connection. You're still permitted to do that work in these circumstances that are outlined. The big caveat is that this is really fluid and really complex. So our suggestion is, if you've got any clients that you think are going to be touching this realm, then you need to go with the client and refer to counsel as well. But again, we feel like this is a big win, and are happy that we've gotten that clarity that a lot of us were looking for.
That's great. Thank you, Lisa. It is a bit of good news. Today, to have one less thing to be anxious about is a good thing. So at least this is directionally moving in the right direction. So thank you, Lauren. Lisa's going to stay with us, and we're going to go ahead and bring in Carrie Hipsack. And Carrie and Lisa are going to take us through a bunch of technical topics that are varied but important.
Hi, Carrie.
Hi, Lisa.
All right, let's talk technical.
Great. As Michael said, they're definitely varied.
Yes, they are. So again, going to be an alphabet soup segment for us. So let's start with the IRS, because this was a common question that we were getting in the town halls. So what kind of news do you have for us?
Yes, for the past couple of town halls, we have been getting questions about the standard mileage rate and if the IRS was going to increase it. With announcement 2022-13, they did go ahead and increase that by 4 cents per mile, making the total standard mileage for business travel 62.5 cents per mile, and that will be effective July 1st. Deductible medical or moving expenses also had the same 4-cent increase per mile, making that total rate 22 cents per mile, and that will also be effective July 1st. There are 2 Journal of Accountancy articles also linked on the slide if you would like more information or background about this increase.
I think we just got some news yesterday that ties in directly to some of the IRS conversations that Lauren and Michael were just having. So fill us in on the latest.
Absolutely. The National Taxpayer Advocate, Erin Collins, released her mid-year report titled Objectives Report to Congress. There is a link to that full report on this slide, and this report is very focused on IRS service. On this slide, I have 4 different areas highlighted. The first refers to paper filed returns. By the end of May, there was 21.3 million outstanding paper tax returns, and this is an increase from the same point in 2021 of approximately 1.3 million. The second point to address refers to errors in taxpayer correspondence. When the IRS makes adjustments, they must communicate with taxpayers via postal letter. As of May 21st, 2022, this process took an average of 251 days. If you'd like another measurement, this is just over 8 months. Compared to pre-pandemic in 2019, this was only 74 days. So there's quite a substantial increase in regards to the postal correspondence.
I think some of our town hall attendees might think that 8 months is overly optimistic based on what their clients are experiencing.
Yes, well, it is an average. So you're going to have outliers on both sides, but that is the average that we saw in the National Taxpayer Report. Another area that was highlighted referred to hiring and training. On one end, in account management, the IRS did almost meet their 5,000 new employee goal by hiring 99% of that goal. However, on the flip side, in their submission processing, they were only able to hire 38% of their 5,473 new employee goal. So quite a discrepancy there. Finally, telephone service. I think we all know that has been a popular topic on the town halls and trying to get a call through to the IRS. In the 2022 filing season, the IRS answered about 10% of all taxpayer calls. This is up about 1% from the 2021 filing season, where it was reported they answered about 9% of taxpayer calls. So while there was a marginal increase in the number of calls that were answered, the average wait time did increase from 20 to 29 minutes.
Goodness. All right. Any good news?
There's some good news in the IRS Dirty Dozen, in that it helps taxpayers know what to look out for to help protect themselves. This is a report that is compiled annually by the IRS. It is what they call the worst of the worst tax scams. They release these between June 1st and June 10th. Some of these are extremely nuanced, so I don't want to go into all of the details. But if you are reading through these and see an acronym or a phrase that you know might apply to you or a client, I would suggest you click on the link that is living in the 2022 list and maybe dig into that section a little bit more. For purposes of today's conversation, let's focus on some of the most popular. On this slide, let's look at the pandemic-related scams. Most of these relate to stealing personally identifiable information, also known as PII. The first is about economic impact payment and tax refund scams. This might be scammers reaching out to taxpayers saying, you're eligible for more than you actually received. Give us your information and we'll help you get that. In the unemployment fraud, what was happening there during the pandemic, obviously there was an increase in unemployment, and scammers were going and filing unemployment claims using some of that stolen PII. And they were the ones receiving the payments. However, it was the actual taxpayer whose information they had stolen that is then receiving the 1099, the 1099-G specifically. That's where unemployment compensation is reported. If any of your clients fell victim to this, I would suggest clicking on this link again. There are steps for remediation. Another way that scammers were collecting information were by posting fake employment offers on social media. They would again use this as an opportunity to collect that personally identifiable information, social security numbers, date of birth, address, etc., and then use it to scam the taxpayer out of funds that might have been due to them. And finally, fake charities that steal your money. In the heart of any crisis, I think most of us feel a little extra giving, but we need to remember and remind our clients that not all charities are actually covered by the IRS. So if they want that deduction, they have to make sure that they are in fact a legitimate charity. So just do your homework and make sure that it is going to be an actual deduction.
All right. And so you've got 6 more on here, but it looks like you're calling out some that are around stealing identity, PII, text messaging. So you've got a resource here that might help us.
Yes, the trend about PII continues. Whether it's text message, email, phone calls, scammers are looking to gain your personal information. With text messages and emails, they might have links and then ask you to enter your personal information once you click through that link. Spear phishing is also related to those scams. The only difference is spear phishing is designed to look like it's from an authoritative source. So a scammer might create an email address that looks like it's from irs@gov.com, and they might sign it the IRS commissioner. So scammers like to go after these individuals one by one. If we could go back real quick, I just want to highlight the cybersecurity checklist. In addition to giving your clients this advice to protect their own information, CPAs are a common target for scammers because they have a treasure trove of PII in one place. So here's a link to the PCPS CPA cybersecurity checklist of a few easy steps that your firm can take to try and keep your firm from being too easy of a target for cyber criminals.
All right. And then I think you've got a quick update on EIDL loans. And really, I think this is just clarifying some of the common questions that we've been getting at the GAQC.
Yes, our Governmental Audit Quality Center released an alert yesterday addressing some of the commonly asked questions related to single audits and which entities are and are not eligible. We have a link to SAM.gov, which highlights that only non-federal entities, such as not-for-profits, with $750,000 or more in EIDL loans are subject to single audit. For-profits with that same amount in EIDL loans are not subject to single audit. There is also clarification on the EIDL program webpage that the audit requirements for EIDL loans only apply in the year that the loan funds were spent. And the SBA goes on to further explain that the SBA does not consider the loans to have continuing compliance requirements after the funds are spent. And finally, real quick, RRF, not subject to single audit. Quick and easy.
Okay. All right. And then this is a topic that we've talked about before on the town hall. So we've in 1 minute or less, Carrie, what do you want to share with us about the QM standards?
Yes, we've talked about the QM standards a few times. The final standards have officially been issued. They do live on the link to the quality management page here. The 4 standards you see listed below are there, as well as support and resources. There is a resource example that we highlighted, which highlights the difference between SQMS number 1 and the legacy SQCS. Acronyms are defined on the slide. And it highlights those differences so you don't have to go through them one by one. There's also some upcoming webcasts to sign up for. And last but not least, the effective date. I know it's December 15th, 2025, but please start preparing your implementation journey as soon as possible.
All right. Thank you, Carrie. I appreciate it. So next, we're going to change topics a little bit. Sales and use tax has just recently come to my sales and use tax hasn't just come to my attention, but just the complexity in the landscape right now since the implementation of the Wayfair decision. And so I wanted to talk about it with an expert. So I'm bringing in Mike Bernard. Mike is the Chief Tax Officer of Vertex, which is a leading tax compliance software focusing on tax automation and how to simplify some of the process around compliance. So, Mike, I'm so glad you joined me. We had a great pre-conversation, and boy, this guy knows what he's talking about. So here's what I thought we could cover in the next few minutes. What's happened in the last 4 years since the Wayfair decision that dramatically changed who would be subject to state requirements around collecting sales tax. Thoughts on a recent Senate finance hearing that happened just last week. Let's touch a little bit on compliance because I know the haunting image of a sales tax audit is no fun for anyone. And then we're going to bring in Jeremiah LaRue from CPA.com so that we can talk about some of the opportunities both for finance professionals in business and industry, but also CPAs and public accounting who want to help their clients. Welcome, Mike. Thanks for joining us. So as we think about the past 4 years, what do you see as some of the key changes that have sprung up post Wayfair?
Sure. So I think most of the folks listening on the call today are well aware that companies or taxpayers who didn't actually have to collect or remit sales tax where they didn't have physical presence, now they have to do that. And so there's been a lot of money that's been built on obviously professional services fees, on actually getting expertise around that, running reports, updating your environment. And so at least for a lot of our customers, what we saw maybe in the mid-market to smaller market, they really had to kind of increase their expertise in that area. And so that was one of the things they had to do. Obviously, another thing that had to happen as well is they actually had to register in those jurisdictions. So once you kind of registered, then oftentimes what happens, Lisa, too, is then you get a full kind of questionnaire from a lot of states, and then they want to know about your income tax. They want to know if you have any property, what's your activity. And so a lot of smaller companies have been burdened with that because in a lot of states where they had to start collecting and remitting, they simply didn't have any of that stuff, but they still had to respond to those questionnaires to make sure that there was no forward movement by the states to actually provide income to try and tax them for an income tax or property tax. So those were some of the key things that we actually saw.
And I love the points that you made about why states might be looking for sales tax, use tax, first receipts taxes as a means to kind of shore up their revenue stream.
Yes, for sure. So if you kind of take a look at the first bullet there and a couple, 3 bullets, one thing that was done at the Brookings Institute, which is a very good tax policy center think tank, put out a really good report not too long ago, about a year ago. And essentially what they did was they looked at the last, say, 60 years of collection of taxes in states and locals. And essentially they were focused on sales and use tax, income tax, and property tax. And what became very apparent through all of that is the one tax that kind of bounces back the fastest. And when I say bounces back the fastest to its normal level before an economic downturn is normally your transaction tax or your sales and use tax. That should make sense to the folks on the call because obviously we have a consumer-driven economy. Income normally goes down. It takes longer to come back. Property goes down. Takes longer to come back. All of those, the income and the property stuff, was an anomaly this last time with the pandemic, basically because there was so much federal money that was pumped into the economy, almost $6 trillion worth of it. But states are more and more looking at actually moving to transaction taxes and moving away from income taxes because of that phenomena, and also because they're generally easier to administer for the most part. Because there are so many preferences in the income tax code. So a couple things to think about there.
So you mentioned that it's easier from the government's perspective. From the small enterprise, it's probably not so easy. I'm sure there's been an expansion in the number of jurisdictions that small businesses are having to comply with.
Right, and the biggest challenge that smaller businesses have had is really trying to take the products that they sell. If they've got a limited product line, say under 100, then normally they have some expertise to actually map those products into a proper category, which tax software actually takes care of and automates all that. But if they have an expanded property product line, then that's awfully tough for them to do. And one thing that we saw with ones that either one, whether you have a smaller product line or a greater product line in new geographies, a lot of those customers actually went to marketplaces because a lot of the marketplaces took care of the collecting, remitting, filing, and reporting all of that revenue and those reports. And so in most states today, if whoever has the financial end of all of that transaction, not the warehousing, not the sales, not any of that, that's where all that responsibility resides. And so a lot of smaller customers have actually just gotten onto marketplaces. And I should also point out too, Lisa, it's not the big marketplaces. It's actually there are smaller marketplaces that have done a really great job. They may be selling specific things like shoes or fire equipment or auto parts or things like that. And a lot of those kind of smaller marketplaces have really been a good place for customers, for people who are selling, to get on there and actually meet their obligations.
And so for smaller businesses that maybe are niched, there might be a marketplace out there that they can target their sales through to take over some of that administrative burden.
That's exactly
Okay.
right.
Got it. And so like Etsy, Amazon, eBay, StockX, those kinds of things, are they assuming that sales tax responsibility as well?
Yes, yeah, because the way the Model Act was written, and just by history here really quickly, a Model Act, Marketplace Act, was actually written about a year. It was finally finalized almost about a year after the Wayfair decision. And so it acted as a kind of a model for all of the states to actually kind of adopt. So they didn't have to write their individual Model Act or Marketplace Act. And so generally, and there's exceptions, Lisa, and you know this, is that generally if you own, whoever has the financial aspect of handling that transaction under the statutes, for the most part, they're the ones who have to collect, remit, and report, and in some instances even defend it. So and then in other instances they don't. They may have to just pass that information to the seller, and then the seller actually then files the return and remits the tax.
Okay.
So those are kind of like the two models, and you just kind of have to know that in each state it's just a little bit different. So
And so I think back to my days before I joined the AICPA. I was running an organization that had retail sales and catalog sales and website sales, and we were shipping to all 50 states. And my whole thing was, I don't have Nexus because I've only got property located in one state. But this just completely changes how Nexus is determined.
It
From a
does.
sales
It
tax perspective.
does. And I want to make a really important point about that when you bring that up. One thing that you have to do is you have to look at the rules as to when you actually have an obligation, because as you know, Lisa, the transaction test or the economic nexus test, the amount of revenue you have in a state is different with each state. But also each one has a slightly different determination date of when you might have to actually file. So when Wayfair passed, we got a lot of calls from our client bases like, well, I've got this amount of sales and I triggered an economic nexus. And we would say, yeah, but if you look at that, you have to meet those standards for a quarter or for a year. So one thing, the practitioners really have to keep their eye on is don't start collecting and remitting until you've actually hit the time period for which that is actually required for you to do. So keep that in mind.
Okay.
Mhm.
And what are you seeing in terms of expanding what's being subject to sales and use tax? So, as an example, the state of Kentucky recently floated legislation to tax CPA services and financial planning. Are you seeing a lot of states trying to change what they subject to tax?
Yes, it's a good question, because one of the things that the Tax Foundation and one of the big four accounting firms did was they actually put out a really good study about a year ago. You can find it on the Tax Foundation website, but it really talked about over the last 30 years the contraction of the actual base in each state upon which sales tax is applied, for the most part, has been going down. In other words, states have been granting more and more and more exemptions. And so now the place where they're really starting, and the only way you can make that up is just keep raising the rate, the sales tax rate. And I think everybody feels that. But now what they're starting to do is just what you said. They're starting to go after professional services. So accounting, law, IT, architectural, those are the kinds of things that they maybe don't touch consumers directly. They may touch businesses more, but that's definitely a place where they're going. And then the other place we're seeing a lot of, where we're doing some work right now, is we have a number of our big customers want to know about NFTs, crypto, a thing that's called digital tipping that we're looking at, and then other digital services on the internet. It could be dating, or it could be other things like that. So that is a ripe area for where states are starting to actually look to actually expand their base.
So I'm sure we're going to see a lot more to come as states look at those potential revenue opportunities. So we'll definitely want to keep that on the radar. I appreciate that.
Sure.
So I think your last point there is spot on. It looks like we need some clear guidance. So if we think about the complexity that we've just outlined, that leads us to the Senate Finance Committee hearing that was held last week. And I think what were your key takeaways from that hearing? Did you?
Sure. I mean, that hearing was really centered around the 5 states, the nomad states, New Hampshire, Oregon, Montana, Alaska, and Delaware, where there's no sales tax scheme in those states. But if you are a seller, if you're located in those states and you sell remotely into another state where there is a sales tax, now because of Wayfair, you have to collect and remit those taxes, those sales tax. So you never had that responsibility up until Wayfair in 2018. And so there were several people at that hearing where they're small business owners who had incurred a lot in, say, software license fees, some in professional services. And they were saying, hey, look, this is really tough on us. And so I think the one thing that kind of came out of the hearing is that there was a quest for action from the senators to actually standardize definitions, maybe to standard economic nexus levels. I think you know this, Lisa, the federal government, there's not a lot of appetite to actually do that or to get a vote on that. So I don't think you're going to see actually that kind of action pass in any way. I think what the folks on the call just need to know is like it's going to continue to be controlled by the states. Hopefully there will be some uniformity, but unfortunately the complexity is going to continue to be the order of the day at this point.
And complexity leads to compliance audits, which is the next thing that I wanted to kind of pick your brain about and just see what your thoughts were. What are you seeing with your clients? Are you seeing an uptick in compliance efforts with states going after newly required businesses within their authority?
Sure. I think one thing that we saw during the pandemic, when the pandemic hit for a couple of years, we saw a lot of our customers they didn't have a digital office. They didn't have a tax digital office. Everything, they worked really hard to kind of get everything built remotely with PCs, login credentials with remote servers and things like that. So a lot of that work was done during 2020. And then in 2021, there was a new emphasis to actually get more automated with actually taking your data and putting it, on a return so that you didn't have to touch the return or handle the data. And so we saw a lot of that. And we've seen there's been kind of an uptick in spending for a lot of companies that have wanted to do that. I think the biggest thing is because it fits the governance model for the company, for the CFO, and it just makes sure that, unfortunately with sales tax, if you get it wrong, it's 7-8% off the top on some sales, and you can't have too many of those. So there was a lot of effort put into tax engines and this kind of automation. So that was the big thing. And then the second thing was audits were paused during that period, from March 2020 till maybe about 6 months now, but we're back to the normal level of activity around all of that. And so you have to be prepared for your audits. I would say one other thing too is when the government comes in and audits you, make sure that you are being very, very thoughtful about your representative sampling, because as most of you know, if they come in and they audit, say, a 3-year period, they're not going to look at every single invoice for 3 years. They're going to select certain numbers of months and just make sure that whatever those months get selected, they're actually representative samples, because from that, they actually extrapolate the results of your audit.
Yeah, absolutely.
Mm-hmm.
So we've talked about the enforcement opportunity or the enforcement risk that's out there, the complexity. So I'd like to bring Jeremiah LaRue in. Jeremiah is a product manager with CPA.com, and he's focused on the Vertex solution that we have to offer. But he's been talking with firms about where they're seeing opportunity. So welcome, Jeremiah. Thank you for joining us, and thank you for introducing me to Mike. He's been a great resource for me. My message from all of this is that this screams for help for most small entities, that they cannot keep up with this manually. So, Mike, Jeremiah, what are you hearing in terms of how best to serve this complexity and help these businesses?
Certainly. Thank you, Lisa. And I'm happy to be here and appreciate this discussion on sales and use tax. And part of my role is understanding the forces in the marketplace, enabling firms with education, resources, and tools to make the most of this latest trends. And so complexity, really, we've kind of hit the nail on the head here in terms of that increased complexity that's driving the opportunity. And much of the reason why there's a business need in place that continues to grow is because of that increased complexity that we've just been discussing. It's really too much to keep up with manually as the complexity continues to increase. As we just said, states are ramping up audit enforcement. It's challenging and stressful for businesses to keep up with those changing requirements. So having the proper tool set in place becomes key to remain compliant. I know that Mike just talked a little bit about the tax engine. So that's where automation and implementing an effective sales tax engine is really becoming table stakes for more and more businesses. Beyond that, as CPA firms and tax departments alike on the call, you guys know the importance of being proactive and having a tech-enabled strategy. And when we think about that tech strategy, we know technology in and of itself isn't a silver bullet. So it's vital to document processes involved in sales tax compliance answer important questions like how does our tax engine connect to the system that's being used, whether it's a CRM, an accounting or general ledger, an ERP, or an e-commerce platform, or even a procurement system. How does that information flow then to the tax returns and even to tax reporting and analytics? And then, of course, best practices, gaining knowledge from subject matter experts like Michael and other practitioners in the space. It's a continuous exercise. Best practices related to things like staffing or billing or sales and marketing of these services, and of course technology. So there's definitely no lack of opportunity for advisors and companies to really jump on board here.
Mike, you had brought up the point about making sure that the entity has documented its processes. Do you want to just hit on that for a second?
Yeah, I'll just touch briefly on that. One of the things is, as most of you know, that SOX applies to the income tax world. But what we've also seen is that if you can kind of put in SOX type documentation for your transaction tax environment, specifically what are the flows, everywhere from a billing system to the output of filing a return. Once you kind of have that document, you can see where you're really strong at. And I think I think Jeremiah knows this as well, is then that becomes a place for opportunity of where you can strengthen things along that entire workflow system. So we've seen companies really, they've moved from, in our polling, have moved from SOX type controls around 40% just say 3 years ago to almost 70 or 75%. So they're really spending some time documenting it. And and I would encourage you to do that if you
I wish we could do a virtual show of hands to see how many people on the call today are actually talking with their clients about their sales tax processes and what their systems look like and what some of the challenges and pain points are. So maybe we can get some insights on that. But you all have worked together to develop some resources that we wanted to make sure we talked about. So Jeremiah, I think this is actually in the handouts for the attendees today. Is
Certainly,
that right?
a couple resources just to call out here. The first is a white paper that features our friend Mike, as well as the sales tax nerd, Diane Yetter of Sales Tax Institute. And it provides their takes on latest challenges in the area of sales and use tax. The next resource is actually from our friends at the AICPA and the tax section. They've developed a wonderful interactive SALT roadmap tool that features not only various tax rates for each state, but also links directly out to state CPA society web pages that gives you really a great one-stop shop for all things state and local tax. And the last resource I'll call out is an opportunity to join us on July 20th for a webinar also featuring Mike from Vertex, as well as a couple of experienced sales tax practitioners sharing more best practices on how to maximize your firm's sales and use tax strategy. So lots of knowledge out there.
Thank you.
Well, hey, I just want to say a big thank you, Lisa. That was excellent. It's a very deep, complex topic. There's a ton of change happening. And so it is very difficult to stay ahead of it. And again, PCPS, AICPA, CPA.com with our friends at Vertex, trying to do all we can to just share information and guidance as best we can with you. So thank you, Lisa, Mike, Jeremiah, excellent overview. We appreciate it. And so with that, we're going to kind of pivot here to open forum. We've got time for a couple of questions, and welcome. There they are. Look at that group. What a great group. Great to have you guys back with us. So let me just direct a few questions you can answer as briefly as you can. And maybe Mike, because that was the sales and use tax was the last topic. Curious just if you're seeing increasing incidents of audits, particularly on smaller businesses. I think a lot of folks sit here and listen and they realize the burden. I mean, it can be pretty daunting. Are you just seeing, I should say, is it discriminate? Is the focus more on larger organizations, or this is as big a small business problem as it is a big business problem?
I think generally what we're seeing right now is that the states are kind of hyper focused on the big marketplaces and the bigger ones because they're actually collecting the bulk of the revenue. They also tend to focus on industries. So restaurants and places that, may traditionally have had audit issues. I will say this, though, there's been this huge move to digital transactions, obviously through the pandemic. So there's a lot of things that are actually getting recorded and reported properly. But I will say that it's more of kind of a big company or corporate mid-market place rather than small businesses at this point.
Yeah, I mean, it's a great point. And I'll even say I was in a meeting just this week on blockchain, and we had a practitioner in the room who is increasingly seeing or needing to find strategies related to crypto and how our clients, are managing that. And so like I said, it seems to be evolving quickly and lots to do there. So thank you for your expertise. Lisa and Lauren, quick question, maybe not so quick, but follow-up question or earlier segment. And maybe Lisa, I'll start with you, and Lauren, you can kind of elaborate. But Lisa, seeing it here today on Q&A, we've seen it in other forms, but taxpayers are increasingly getting the CP14 notices, but even though payments have already been made. So any guidance or advice for attendees on that?
I think we are definitely hearing about it loud and clear, and it seems to be maybe a couple of different issues. One is that it relates to that big backlog of IRS correspondence and unopened mail that is growing, not shrinking. So a payment might be sitting unopened or unapplied, even though the check has been cashed or the payment has been processed and the taxpayer knows that the payment has been sent in. Another instance that we're hearing about is where the spouse of the taxpayer made an estimated tax payment or sent in a payment for the liability due with the return and put their social instead of the primary taxpayer social security number that was listed on the tax return. Don't get me started. But that seems to be causing a lot of these incorrect notices. Right now, the recourse right now is just you got to get your documentation, try to contact the IRS. But as every conversation we've had for the past 2 years is, that's not always as easy as it sounds.
Lauren, are you seeing, from the Congress side of,
Yeah, we are seeing, I'm just going to, what Lisa just said, it's got to be so frustrating. And we know it's frustrating to be told, contact the IRS. And you're like, well, I've been trying, I can't get through. And there are members of Congress that are very much keyed into that. There's a senior member of the Senate Finance Committee who's already reached out. He wants to talk about CP14 notices with us. So you're going to see some congressional anger directed at the IRS again pretty soon.
And we can talk about it on the next Washington, D.C. tax brief. So for those of you who've tried to register and have encountered that difficulty, don't fear. We'll get that fixed. I'm not sure what the challenge is there, but we'll communicate the link out to register in the next town hall newsletter that you'll be getting next week. So apologies for that frustration.
Thank you, Lisa. And thank you all. Just another great session. Lots of great content shared. So we appreciate all of your expertise. And so we'll keep moving here. So in summary, again, hopefully everyone enjoyed today's town hall. We had a very big group on today, so it's exciting that even with, as the calendar turns to summer, still a lot of interest and activity on the town hall. So what did we talk about today? Again, it's going to be a busy July in DC as the majority try to make headway of a lot of issues that typically will drive some tension as we make our way toward midterms. There's a lot of shuffling and pushing back and forth. So be prepared for that. We'll be tracking things very closely. Again, Carrie talked you through the optional standard mileage increase. Stay vigilant. Carrie reviewed the Dirty Dozen scams. While they are most prevalent during filing season, criminals really don't have any downtime. So be on the lookout for those activities. Again, we close with sales and use tax landscape. Whether you're an industry or you're a firm supporting clients, it does have a big impact. And so hopefully you gleaned a lot from the takeaways from the recent hearing. With that, if you want to go back and see any of our recordings of recent town halls, they are listed on the website, and here's a list of all of the most recent ones that we've shared. July 7th is going to be our next AICPA Town Hall air date. It'll be featuring Ron Baker. For those of you that don't know Ron, he is one of the absolute foremost experts on value pricing, and really is going to be talking about this whole concept of concierge services, and at least get you to think about that in the context of your practice. It's a very interesting discussion. I've heard Ron talk about it before, and he's a big advocate for subscription pricing models for professional services, and he's going to really focus in on that. So with that, hope to see you all again on July 7th. Eric and Barry will also be back with us. Hope you all have a great rest of the week, and we'll talk to you again soon on the 7th. Take care and have a great afternoon.
Thank you for your participation. You can now subscribe to the AICPA Town Hall series on your favorite podcast platform, as well as watch archives on YouTube and AICPA TV. Tune in for live broadcasts Thursdays at 3 p.m. Eastern Time.